Welcome to The Explainer. Today, we're going to talk about something that trips up a lot of investors. It's this dangerous trap where you see these huge revenue numbers, but they don't tell the whole story. It's one of those classic cases where what you see on the surface is, well, it's not what's really going on underneath. So let's start with a bit of a puzzle. Imagine this. You're looking at a company, let's use Opendoor as our example. You see their revenue, and it's massive. We're talking billions of dollars. But then you look at their stock price, their market valuation, and it just seems kind of low, right? It doesn't seem to match up. So what's the deal? Did you just stumble on a hidden gem, a super undervalued stock? Or is there something you're completely misunderstanding here? Okay, so to figure this out, a lot of investors will reach for a metric called the price-to-sales ratio. You'll hear it called the PSR. And it's really simple, right? You just take the company's total market value and divide it by all the money it brings in, its annual revenue. It's super popular for those growth companies that aren't profitable yet. And the thing is, when you get a low PSR, man, that stock can look so cheap, like an absolute steal.
And that's exactly what happens. People see Opendoor's huge revenue, they run the numbers on the PSR, it comes out low, and they think, wow, I found a bargain. But this is the trap. There's a critical detail about that revenue number hiding right there in plain sight that just changes the entire equation.
So the whole thing, this whole potential misunderstanding, it all comes down to one single word: revenue. You might think revenue is revenue, but it's not. What revenue means for a company like Opendoor is worlds away from what it means for, say, a typical platform company. And getting this difference, well, it's everything. Okay, this is really the heart of it all. Think about a regular platform, maybe like Amazon's marketplace. If someone sells something for $100 on there, and Amazon takes a $10 fee, Amazon's revenue is just that $10. That's it. But Opendoor? Totally different story. When they sell a house for, say, $400,000, they record the entire $400,000 as their revenue. See the difference? It's huge.
And because of how they count revenue, you get this absolutely massive gap in profitability. We're not talking about some little accounting detail here. No way. This completely flips the financial picture upside down and creates this enormous divide in their actual profit margins. And here's what that looks like in the real world. That typical platform, its costs are pretty low, right? So its gross profit margin can be like 70%, really healthy. But Opendoor, well, its biggest cost is the house itself. It has to buy the thing first. So after they pay for the home they just sold, their gross margin is tiny. We're talking only about 5%. So here's the bottom line. You do the math, and $1 of revenue for a normal platform company is about 14 times more profitable than $1 of revenue at Opendoor. Let that sink in. 14 times. So comparing them directly using something like a PSR, it's not even apples and oranges. It's like comparing an apple to an entire apple orchard. They're just in completely different leagues. Okay, so if the good old price-to-sales ratio is basically broken here, how are we supposed to value a company like this? We've got to find a way to adjust for this massive difference in their business models. And the source material actually gives us two pretty clear ways to think about this and get a much more realistic picture. All right, here are the two options. Option 1, you could take whatever PSR multiple you think a normal platform should have and just divide it by 14. That'll give you a normalized comparable multiple for Opendoor. Or, and this is probably the better way to do it, you could just ignore revenue altogether. Yep, just forget about it and focus on the number that really tells the story here, the gross profit. Let's put some real numbers to this to make it super clear. Let's say you think a good platform company deserves a price-to-sales ratio of 6. Okay, now, if we do our little adjustment to make it a fair comparison, what would Opendoor's be? It would be around 0.5. Now, a PSR of 6 and a PSR of 0.5 look like they're from different planets, right? But when you account for the business model, they could actually represent a very similar underlying value. And this really gets us to the biggest lesson of this entire explainer, because this isn't just about Opendoor's stock. Not at all. This is a way of thinking, a tool that every investor needs when they're looking at any company that's posting these massive revenue numbers. The source material just says it perfectly. Thinking a company is undervalued based only on its revenue is a very dangerous misunderstanding. It's a huge mistake. You're confusing a high volume of sales with high value, and that's what leads people to think a stock is cheap when in reality it might not be at all. So what's the big takeaway here? It's that you have to dig deeper. That big headline number, that's just where the story begins. You've got to ask yourself, what does this revenue number actually mean? What are the real costs behind it? And you know what? More often than not, the gross profit is going to tell you a much more honest story than the total revenue ever will. Simple metrics are fine, but without context, they can be really, really misleading.
And really, at the end of the day, this isn't about one specific company or one industry. It's a whole mindset that you can apply to pretty much any investment you look at. So the next time you see a company with these eye-popping, gigantic revenue numbers, just take a second, pause, and ask yourself one simple question. What do these numbers really mean? Because finding that answer, well, it could change everything.